The biggest housing crash of our lifetime has begun, and homes could plunge 70%. Silent, relentless, and already reshaping America, this implosion eats equity, shatters affordability, and turns ownership into debt servitude. Mortgage rates, exploding household debt, and institutional fire sales are colliding now, not later. If you own a home, want to buy, or hold property, this video shows the hard math, the unseen chain reactions, and exactly why prices may fall far beyond what anyone expects. Hit like, share this warning, and subscribe now. You need to know what to do next. Act now, urgently. For years, the housing market looked stable on the surface. Prices kept climbing, sellers stayed confident, and buyers felt pressured to grab anything they could. But while everything appeared normal, trouble was building underneath. It wasn't dramatic, and it didn't show up all at once. It grew slowly through rising mortgage rates, heavier household debt, and paychecks that could no longer keep pace with basic living costs. These shifts didn't merely weaken the market, they changed the entire balance that kept it alive. The turning point didn't come with one big headline. It came through thousands of small changes happening at the same time. Higher interest rates pushed monthly payments to levels many families couldn't handle. People who had stretched their budgets now discovered those budgets no longer stretched far enough. The moment buyers stepped back, the market lost the force that kept prices climbing. Sellers noticed the slow change immediately: fewer inquiries, fewer offers, and more time waiting for a sale. Homeowners didn't feel the impact right away. Housing downturns rarely start with fear. They start with hesitation. A little more time on the market. A price cut that seemed minor. A buyer walking away after months of planning. These small signals reveal something deeper: the market is no longer moving with confidence. This calm, quiet shift is the most dangerous stage. It gives the impression that the slowdown is mild, temporary, or harmless. But behind that calm is a market losing strength every month. More listings appear, but fewer buyers show up. Investors pause their purchases. Young buyers delay plans. And sellers begin questioning whether they missed the best moment to exit. All of this leads directly to the next phase, the part where the early pressure begins to show in visible ways. Not panic. Not collapse. But clear signs that the ground beneath the market is changing. The first obvious cracks appear quietly. They don't show up as mass foreclosures or dramatic headlines. They show up as a change in attitude. Buyers who once rushed to submit offers now take a step back. They want more time. They want better prices. And most importantly, they no longer believe they must buy before it's too late. This change in belief is enough to shift the entire direction of the housing market. Affordability has dropped to its weakest point in over 30 years. But the real problem goes deeper than high prices. It's the simple math: families cannot buy a home if half their income disappears into a monthly payment. When the numbers stop working, demand doesn't just soften, it collapses. People stop looking. They stop applying. They stop competing for homes. Once demand falls, sellers feel the pressure. The excitement from previous years disappears. Homes stay on the market longer than expected. Price cuts become common, not rare. And the belief that there will always be buyers begins to fade. Investors notice this before anyone else. They pull out of markets that once looked safe. Their exit removes another layer of support. At the same time, rising inventory creates a new problem. More homes are listed, but fewer buyers are ready. New construction adds even more supply. Renters who once planned to buy now decide it's smarter to wait. This creates a standoff, but only buyers can afford to wait. Sellers eventually must adjust. Confidence weakens further as families face higher costs, tighter budgets, and job uncertainty. When confidence drops, recovery becomes much more difficult. People don't just hesitate, they stop trusting the market. These are not random signals. They are the early signs of a deeper downturn forming underneath the surface. As buyers step back and confidence drops, the next group affected is homeowners. Many of them entered the market during the years when prices were climbing quickly, believing the trend would continue forever. They expected their homes to gain value year after year. But now, with fewer buyers and more listings, homeowners are beginning to see a different reality. It usually starts with something small. A neighbor's home, once priced high, suddenly sits on the market for months. Another neighbor quietly reduces their asking price. Someone else pulls their listing after receiving no serious offers. These events don't draw headlines, but they send a clear message to homeowners: the market is not behaving the way it used to. This creates a new type of pressure. People who plan to sell in the near future now worry they might not get the price they expected. Families thinking about upgrading to a bigger home start to hesitate. Those who refinanced at the peak of low interest rates feel lucky, but also trapped, because if they move, their new mortgage will be far more expensive. At the same time, homeowners with adjustable rate mortgages face sharp increases in monthly payments. Their financial plans begin to tighten. Some start wondering whether selling might be safer than trying to manage higher costs. But they face a problem: selling into a cooling market often means accepting a lower price. This shift in behavior creates more supply. Properties that would normally sell quickly take longer to move. Sellers begin to adjust expectations. Some cut prices early to avoid waiting. Others hold firm, hoping the market will turn around. But the longer they wait, the clearer the trend becomes: the demand that once supported high prices isn't there anymore. The growing number of hesitant sellers and uncertain buyers creates a slow, steady pressure on the entire system. Nothing dramatic happens overnight, but each week adds a little more strain. And as financial stress spreads across homeowners, it leads to something even more important: a change in how lenders view the market. Once lenders recognize that buyers are struggling and sellers are lowering prices, they begin adjusting their own rules. Their first move is often quiet: they simply become more selective. Applications that would have been approved 2 years ago now face extra checks. Borrowers need higher credit scores, stronger income proof, and larger down payments. This shift alone reduces the number of people who can qualify for a home. Banks do this for one reason: they sense rising risk. When homes take longer to sell and prices lose strength, lenders worry about the value of the properties behind their loans. A home that is worth $400,000 today might be worth less next year. That risk makes lenders cautious, and cautious lenders slow the market further. This new environment affects everyone. First-time buyers face the hardest challenge. Even if they find a home within their budget, getting approved becomes a hurdle. Families who hope to upgrade find the approval process more difficult than expected. Investors who rely on financing begin stepping aside because the numbers no longer work. This tightening also affects homeowners who want to refinance. Many discover their home's value is no longer high enough to secure a new loan with better terms. Some are denied entirely. Others receive offers that make no financial sense. This leaves many people stuck with their current mortgage, even if their financial situation has changed. As lending slows, the entire housing market loses one of its last sources of support. When easy credit disappears, demand shrinks even more. Sellers who were counting on a steady flow of buyers find themselves in a tougher environment. Homes stay on the market longer. Some sellers reduce prices repeatedly just to attract attention. Meanwhile, builders face their own set of problems. Financing large projects becomes harder, and the cost of borrowing rises. Construction slows or pauses altogether. New developments that once seemed profitable now carry too much risk. This disrupts the supply pipeline and increases uncertainty across the industry. These changes mark a clear turning point: the housing market is no longer supported by buyers, investors, or lenders. Every group is moving carefully, and every decision adds more pressure. As lenders tighten their standards and the flow of new buyers slows, the pressure naturally shifts toward renters and local communities. Even people who never planned to buy a home start noticing the effects. When fewer buyers enter the market, more households stay in rental properties longer than expected. This increases competition for rentals, leading to rising rents in many areas, even as home prices soften. The first signs appear in job markets connected to construction, lending, and real estate services. Hiring cools. Overtime hours shrink. Some companies freeze new positions. While this doesn't create immediate job losses everywhere, it signals a change in direction, a shift from expansion to caution. Consumer spending also adjusts. Families who feel pressure from rising rents or higher mortgage payments cut back on non-essential purchases. They delay vacations, skip big purchases, and focus on managing monthly bills. Retailers, restaurants, and service businesses begin noticing slower activity, especially in areas tied closely to housing growth. Banks, too, become more guarded. With fewer mortgages being issued and more economic uncertainty, they tighten other forms of credit as well. Personal loans, credit cards, and business financing face tougher approval conditions. This makes it harder for both families and small businesses to stay flexible during difficult months. Government data eventually reflects these shifts: weaker home sales, slower construction, reduced lending activity, and softer consumer numbers. Each category alone may seem manageable, but together they reveal a clear trend: the housing market is pulling the wider economy into a slower, more cautious phase. This point marks the start of a deeper transition. It's no longer just buyers, sellers, or renters feeling pressure. The entire economic landscape starts adjusting. As the broader economy cools and pressure spreads, households begin thinking differently about their long-term plans. Families who once felt confident about buying, upgrading, or relocating now approach every major decision with caution. The slowdown that began in the housing market is now influencing careers, savings goals, and even lifestyle choices. Many households choose to delay big steps. Couples postpone moving to a larger home because they're unsure how high monthly payments will be. Young professionals push back plans to purchase their first property because prices still feel disconnected from their income. Retirees who hope to downsize reconsider selling, worried they may receive less than expected. This shift in behavior also affects how people handle debt. With rising costs, more families focus on paying down credit cards or building emergency savings instead of taking on new commitments. This change is logical and responsible, but it further reduces demand in the housing market, reinforcing the slowdown. Parents with school-age children feel a different kind of pressure. Many families prefer to move into specific districts before the academic year begins, but uncertainty prevents them from making the leap. This results in more families staying in rentals longer than planned, which adds pressure to already crowded rental markets. Even daily habits begin to shift. Households look for ways to reduce expenses: fewer outings, more home-cooked meals, delaying large purchases. These choices may seem small, but they reflect a population adjusting to a slower, more expensive environment. All these decisions, delayed moves, tighter budgets, postponed purchases, signal a change in the way families approach the future. The housing market isn't just influencing where people live, it's shaping how they plan their lives. As more households slow down their plans and tighten their budgets, communities begin feeling the combined impact. Neighborhoods that once saw steady turnover now experience longer periods of inactivity. This may not sound dramatic, but it changes how an area grows, how local businesses operate, and how future investments are made. Fewer home sales mean fewer new families moving in. Schools that once expected rising enrollment now face unpredictable numbers. Local shops that relied on new residents for steady business notice quieter months. Service providers, from home maintenance to childcare, begin seeing gaps in demand that never existed before. Communities that depend heavily on new development face the toughest adjustments. When builders scale back projects, it limits job opportunities and slows population growth. Empty lots remain unused longer than expected, and planned neighborhood improvements often get postponed. At the same time, long-term residents become more cautious. People hesitate to spend on home renovations because they're unsure if they'll recover the cost later. Others avoid listing their homes because they don't want to compete in a market with more supply than demand. This collective caution slows both economic activity and community development. Local governments also feel the shift. Revenue from property transactions, building permits, and fees declines. This puts pressure on budgets for public services, recreation centers, road maintenance, and housing programs. Even well-managed towns must adjust their plans to match the slower pace. What emerges is a sense of uncertainty becoming the new normal. Communities aren't collapsing, but they aren't growing like before either. They're waiting, just like households, to see where the market heads next. As communities adjust to slower growth and households remain cautious, the market begins moving toward a point where small problems start becoming noticeable trends. Nothing dramatic happens in a single day, but the overall direction becomes clearer. Demand is weaker, listings stay active longer, and both buyers and sellers grow more unsure about the future. This combination brings the market to a stage where confidence, not numbers, becomes the most important factor. Buyers feel pressure from high costs, and as long as they believe prices might fall further, they prefer waiting. This mindset alone slows activity more than any interest rate change. Sellers, meanwhile, cannot ignore the shifting environment. Homes that once attracted multiple offers now struggle to get a single strong inquiry. Many homeowners begin questioning whether holding onto their property is safer than selling in a market that no longer guarantees quick results. This also affects real estate agents, builders, and lenders. They adjust their strategies and expectations based on the softer market. Agents focus more on finding qualified buyers rather than attracting crowds. Builders think twice before starting new projects. Lenders prepare for slower business and rely more on safe, low-risk applications. All of these decisions gradually shape the next stage. By this point, the slowdown isn't just a phase, it starts feeling like a new reality. The gap between what sellers want and what buyers can afford becomes wider, and the pressure on households and local economies continues to build. Once the market reaches this turning point, the next phase becomes easier to understand. The housing market doesn't collapse suddenly, instead, it moves through stages, each influenced by how people react to changing conditions. With weaker demand, tighter lending, slower construction, and cautious households, the months ahead are shaped by behavior more than anything else. Buyers will continue to wait for stability. They want signs that prices are fair, that interest rates won't rise further, and that their financial situation feels secure. Until then, many will stay on the sidelines, focusing on saving money and reducing risk. Sellers will adapt in their own way. Some will hold off listing their homes, hoping for better conditions. Others will adjust their expectations and accept lower offers to move forward with their plans. Price reductions may become more common, not because sellers want to lower prices, but because the market will demand it. Communities will continue adjusting as well. Local businesses may shift their strategies, focusing on services rather than expansion. Construction companies may slow down but remain ready to respond if demand returns. Schools, councils, and community organizations will operate more cautiously, planning for steadier, slower growth. The overall direction of the housing market will depend on how long households feel financial pressure and how quickly confidence can return. The next phase isn't about a dramatic crash, it's about a prolonged adjustment period that shapes how people buy, sell, rent, and plan for the future.